Joining me now is Drew Pettit, U.S. equity strategist over at Citigroup. Drew, you heard the conversation right now from the macroeconomic perspective. How do you frame that against the market that is still kind of near record highs, but is showing sometimes some signs, at least, of potential short to medium term weakness?
Yeah, it's funny. We've been saying this for a few years now, Dom. The market is not the economy. So the right side of the brain, the creative portion here of the market, is what's going on with AI and productivity. And that is huge in the S&P 500. By our estimates, AI is driving, let's call it half the S&P. The other half, that's where the left brain, the cyclical, the traditional macro connection comes in. And to us, softening expected. As long as we don't get to recession, we should actually see inflecting earnings growth for small cap and cyclicals into 2026. When you put that together, structural spending in AI, tech build out, productivity enhancement from that, and a cyclical recovery in 2026 sets you up for a decent bull case to continue. Just short term, a lot of good news is priced in.
All right, so if all the good news is priced in right now and we could expect to see a pullback, how deep could a pullback actually get? It seems as though these pullbacks keep getting shallower and shallower.
Yeah, to us, fair value is about 6,600 for the S&P when you discount earnings coming back. Look, sentiment over and undershoots all the time. We barely land on fair value over history. But I think that's a decent entry point when you think about the longer term opportunity. The reason the pullbacks keep getting shallower is those base earnings keep going up. That's supportive of the market. As long as we have good earnings growth, you have to think the trajectory of markets is still up longer run.
Now, if that's the case, fundamentally, it sounds like the story is intact for the bull market to keep going higher. Is it going to be a scenario where we do see the rotation effect start to really take hold in earnest, not just kind of the mini, I want to say meltdown, but it's not even really a meltdown, but the AI trade is certainly cooling off. Are we going to see some more moves into other key areas of the market that are not tech or telecom?
Yeah, I think so. I think you end up seeing it in the cyclicals. And it's funny, it's not necessarily lasting rotations. You can actually keep beta in your portfolio. We actually like having the growth beta and the AI beta paired with some cyclical beta. So what ends up happening is they don't both work at the same time, but over medium-term horizons, they can actually both outperform. That's something you've actually seen in the last couple months. So to us, it's, buy beta. You probably buy small cap and cyclical beta with new money, and you buy the growth beta and the AI trade on pullbacks like we're seeing recently.
So if that's the case, are there specific parts of that market within the barbells on the large cap tech, media, telecom side and the small mid cap side of things where you would actually divert resources to? What are the picks?
Yeah, it's funny. When we're thinking AI, we always talk about AI at a reasonable price, kind of our GARP approach. And here, we do like NVIDIA and the semiconductors. I think you actually have some kind of upside to what's priced in. I think consensus numbers are above what the market's pricing in. Additionally, you probably do want to diversify, get some power gen, get some enablers of AI technology as well. So a couple names that kind of stand out, Amazon, again, a big enabler. I think you can put money to work there. And then on the cyclical side, we're looking for productivity enhancers and inflections in quality. I think there's some really interesting names in healthcare, like a Boston Scientific, in financials like Capital One, and even in a name like Equifax, where you might see the mortgage market improve in 2026.